We at Warburg believe that markets are quite efficient. That doesn't mean, however, that it is not possible to beat markets. Empirical evidence strongly suggests that deviations from market cap weighted benchmarks can offer a wide potential for outperformance. One way to exploit this potential is to systematically harvest risk premia.
Harvesting risk premia seems to be a standard procedure these days, but a lot of things actually can go wrong. For example, imagine a value factor portfolio. A value factor portfolio consists by definition of equities with attractive valuation ratios. However, these equities typically also exhibit huge drawbacks.
That is actually the reason why some equities are so cheap. The balance sheet quality is often low and the price volatility in many cases high. That is why we talk of risk premia. You collect a premium for holding special equities with special risk-related properties.
By now, investors have understood that single smart beta portfolios based on a single factor portfolios are not an ideal way to harvest risk premia. The relative performance of those portfolios relative to benchmarks is so unstable that you need a very long investment horizon to collect a positive premium with a high degree of certainty.
The standard approach to generate a more constant outperformance based on factor investing is to focus on different factors at the same time. This idea seems to be straightforward, but the devil really lies in the details. At the end of the day, it all comes down to trade-offs between factor exposures. Cheap equities are not profitable, profitable equities are in many cases volatile, equities with a high balance sheet quality are in many cases large cap companies, and so on. A positive factor exposure usually goes along with a hidden negative factor exposure for many other factors, so there is really no free lunch.
At the end of the day, multi-factor portfolios in many cases don't deliver what they promise. The net exposure to the factors is much lower than you would expect. Trade-offs destroy much of what you want to see in multi-factor portfolios. This is why standard approaches to build multi-factor portfolios do not work as well as they are supposed to. For example, an equally weighted portfolio of different single-factor portfolios offers, on a net basis, a rather disappointing exposure to the different factors. And what makes matters worse, the overall exposure to the different factors is not stable, but rather jittery and completely uncontrolled as time goes by.
Our team at Warburg took a very close look at these problems and decided that there must be some kind of solution. From a mathematical point of view, it became clear that we have to understand the structure of trade-offs between the factor exposures. We had to come up with a solution that actually utilizes this information based on the specific trade-offs.
To make a long story short, we developed an approach that simultaneously takes trade-offs between factors into account and selects single stocks in a way that the exposure to all relevant factors is attractive and balanced on the portfolio level. We really think that this approach is unique in the factor investing universe. We are proud for having found a solution to deal with the trade-offs in an efficient manner. From our point of view, this approach really opens a new set of opportunities in building factor portfolios.